Hello, everyone. Welcome back to another episode of the Week in Charts. I'm your host, Charlie Bilello, bringing you the most important charts and themes that are going on today in markets and investing. If you're watching this on YouTube, take a moment, hit that subscribe button for all the latest content. If you're watching this looking for a second look on your portfolio or your financial plan, now's the perfect time to reach out to us at Creative Planning. Go to creativeplanning.com/Charlie, fill out this form, and you're going to get a free wealth path analysis. We're going to look at your portfolio, look at your plan, making sure you're on the right path to financial independence. Reach out to us today, creativeplanning.com/Charlie. We're in all 50 states, so we likely have a location right near you. Over 345 billion in assets under management and advisement, and we're here to help. Reach out to us today, creativeplanning.com/Charlie. So what's on the docket today? A lot to talk about. We'll start out with the CPI report. Unyielding inflation is the headline there. Number two, we're going to discuss the Fed, why they're going to be on hold for a little bit longer here. Another record high for earnings. So we're about 3/4 of the way through earnings season. We'll talk about the latest data there. Everything is up. That would be every major asset class so far in 2025 in the green. Number five, why home price appreciation is slowing, and my belief is it'll likely continue to slow. We'll talk about the data there. Six, DOGE has a savings tracker now that's been created, and so we'll discuss that, so showing some interesting stats there. And we'll end, as we always do, with something positive, and that will be rising real wages in the U.S. Okay, let's discuss the latest CPI report, unyielding inflation. You could see the chart here of CPI and core CPI. CPI moving up to 3%, core CPI remaining above that 3% level. Core CPI, of course, in excluding food and energy at 3.3% there. Both of these above expectations heading into this report. And you can see here just a reversal in the past few months in terms of inflation was trending lower, hit that peak level in June 2022 of 9.1%. That was the highest inflation we've seen since the early 1980s. And then we just saw a downward trend hitting actually a low point of 2.4% last September. But since then, trending upward and again hitting that 3% for the overall number. If we look at the rate of inflation above 3% for core CPI, this is now 45 consecutive months above that 3% level. So we've now had elevated inflation for quite some time. This is actually the longest period of high inflation we've seen in the U.S. since the early 1990s. Let's discuss a breakdown here in terms of major components. Where is that 3% inflation rate coming from in the U.S.? And you can see transportation remains a big issue. 8% increase over the last year. Gas utilities up 4.9%. Shelter definitely improving, but still elevated 4.4%. The expectation is that's going to continue to trend lower because of the real-time rental data that we've been talking about, which is actually showing a decline on a year-over-year basis. Food away from home remaining elevated here, 3.4%. And you can see the other categories here. Gasoline actually down year over year, new cars down year over year, and fuel oil down year over year. But let's talk about that transportation number. What's a big driving force for that number being so high, 8% over the last year? Well, that would be car insurance rates, which continue to increase here. 55% now increase over the last 3 years. You likely have experienced this yourself again and again. I just got my latest premium showing another huge increase over the last 6 months, and it just seems to continue to march upward, well above the rate of overall inflation. And 55% over a 3-year period, that's the highest we've seen in the U.S. since 1975, 1978. So you have to go back a long time to see car insurance rates rise this much over a 3-year period. If we're talking about groceries, this has been a big one for a lot of people. Price of eggs is back in the news once again. We had that spike higher a few years ago, came all the way back down, and now we're at a record high here. $4.95 for a dozen eggs. This is the average price in the U.S. You might be paying more, you might be paying less depending on where you live, but this is a 96% increase over the past year. And what's causing this? Huge decrease in supply due to the bird flu, similar to what we saw a few years ago. Is it going to stay this elevated? Hopefully not. Hopefully this will be alleviated and it'll come back down in the months to come, but definitely a factor in terms of driving grocery prices higher over the past year. If we're looking at the cumulative effect of inflation, this is what people are really feeling. So that 3% number is just what's happened over the past year. What people are feeling is multiple years of now of high inflation. And I'm just illustrating some of the categories here over the last 4 years. Looking at egg prices, 238% higher, auto insurance, 61% higher. If we look at home prices, 39% higher, restaurant prices, 25% higher, groceries 23%. So it's really the cumulative effect of inflation that's caused a lot of pain for people, especially if your incomes haven't gone up this much. And for most people, that's been the case where incomes haven't kept pace with a lot of these categories. But the good news, as we'll talk about at the end, is over the past year, we've seen actually wage gains outpace price gains. So hopefully that continues, and hopefully, obviously, prices come down, or at least the rate of inflation comes down. 3% simply too high for most people. Okay, if we're talking about the break-even rate of inflation here, this is the market's expected rate of inflation, and what you're seeing here is a big move higher since the Fed started cutting interest rates last September. We're all the way up to 2.66% in terms of what the market is pricing in over the next 5 years. That's the highest break-even rate since March 2023. And if you listen to Jerome Powell a few months ago, what he said is they're watching this very closely. They're not going to let inflation expectations rise substantially. So what is substantially? Is this too much? It seems to be too much for the Fed to continue cutting interest rates, as we'll talk about in a little bit. And finally, it's not just the CPI data that's showing higher prices. We're seeing here producer prices up 3.5% over the past year. That's the highest increase in producer prices since February 2023. So many signs here of rising inflation in the U.S. Let's talk about the Fed then. How is this report going to impact the next Fed meeting? Well, the market's essentially saying no chance the Fed is going to cut rates when it meets in March here. 96% probability that they stay at 4.25 to 4.5%. And if we look at the May meeting, still a pretty low probability there, 84% that they're just going to keep rates steady at that meeting. And going to June, 60%. So essentially, market saying first half of the year, the Fed is going to stay at 4.25 to 4.5% because of this high inflation that we're seeing here. And it's not going to be close enough to their 2% target for the Fed to feel comfortable to continue cutting interest rates. So remember, they cut 100 basis points last year. And what did the market do? Well, long-term interest rates rose substantially, essentially sending a message to the Fed that you might be done with inflation, but as we saw in the CPI report, inflation is not done with you just yet. And we had some statements here from Powell. He testified before Congress this week, and he essentially confirmed we're not there yet. We want to keep policy rates restrictive for now, which to me means really not much of a chance of a cut at that March meeting. Looking out further than that, it's hard to say because the data could change very quickly. But in terms of that March meeting, very unlikely the Fed is going to move here. And I don't think they should move because in terms of that 2% target, we're not there in terms of year-over-year inflation. We're at 3%. But really, what you should be measuring, what the Fed should be looking at, is cumulative inflation. And since the start of 2020, we've seen CPI annualize at 4.2%. So we're well above that 2% target if you look at cumulative inflation, and we're about 11.5% in terms of if inflation was just running at 2% since January 2020, well, we're 2%, we're 11.5% above that level in terms of actual inflation. So for the Fed to say we're at 2%, well, maybe that'll happen at some point this year, but it's not going to happen on a cumulative basis. We know the Fed doesn't look at that cumulative number, but once again, I believe that they should. If we're looking at the unemployment rate here, this is the second reason why the Fed is likely to stay at 4.25 to 4.5% is you don't yet have any pressure on labor side. So we're seeing a 4% unemployment rate in the U.S., well below the historical average. So if they're looking at their dual mandate, price stability, and maximum employment, well, employment picture is still looking pretty good. So the focus has to be on price stability, and a 3% increase in prices over the past year, well above the Fed's stated target of 2%. So the Fed, for the time being, is going to be on hold, and I think that's the right decision. Okay, number three here, another record high for earnings. So we're about 3/4 of the way through earnings season. 75% of S&P 500 companies have reported. And I think by and large, pretty good numbers. Definitely more beats than misses overall here. And you're seeing this is trailing 12-month operating earnings in the U.S. Once again, hitting a record high, $234 in operating earnings for the S&P 500. That's about a 10% increase over the past year. So pretty good earnings numbers. If we're looking at some of the big reports here, Amazon, another huge quarter, 10% increase in overall revenues in Q4. And just crazy, crazy stats here. Record quarterly revenues in Q4, 188 billion, and record profits at 20 billion. That was up 89% year over year. Amazon also reported their highest operating margin ever in the fourth quarter at 11%. And in terms of AWS, obviously big driver in terms of growth for revenues and of course the bottom line for profits. This is just unbelievable. The 37% compounded growth rate for AWS over the last decade, and its revenue today, around 108 billion, is actually by itself. So forgetting the other parts of Amazon, by itself, AWS is bigger than the revenue of 468 companies in the S&P 500. Just an incredible stat, an incredible growth rate over the last decade. And if we look at Google here, 12% increase in their revenues over the past year. They also had record quarter in terms of revenues, 97 billion, and record profits, 26.5 billion in profits for Google. That was up 28% year over year. So if we're looking at the revenue picture here for some of the biggest names, you got Meta, 21% increase over the past year, Netflix, 16%, Microsoft, 12%, Google, 12%, Amazon, 10%, Apple, just a 4% increase. S&P 500 revenues up about 3% year over year, and Tesla at the bottom of the list here at 2%. And if we look at the big four in terms of revenues, big four tech company revenues here, we got Amazon, Apple, Google, and Microsoft. You add them up, and you're at 1.65 trillion in combined revenues for these four companies. And when you put them together, that's bigger than the GDP of all but 15 countries around the world. So just amazing, amazing growth in these four companies over the past decade and continuing to hit new highs in terms of revenues, in terms of profits. And I want to end the earnings section here just looking at CapEx spending, because this is the belief that this is going to lead to a huge increase in terms of earnings, that this spending is going to pay off. And we've talked about the high multiples for all of these companies, but just incredible increase in CapEx spending over the last 6 quarters. Amazon increasing their spending 143%, Meta 135%, Google 107%, and Microsoft 77%. Just enormous increases here in terms of that spending. A lot of it building out the data and AI infrastructure. So we will see very soon in the next few quarters, is this going to pay off in terms of increasing profitability? The market, of course, is betting that the answer to that question is going to be yes, assigning a pretty high multiple to technology stocks and these companies in particular. And that's going to be, I think, the big question in 2025. How much of this is going to be translated into bottom line production in terms of earnings, or is it going to be pushed out into 2026? Okay, let's discuss the markets here quickly. Everything is up, so 100% of the major asset classes positive so far in 2025. Yeah, we're only a month and a half into it, but pretty incredible. Everything is in positive. Gold leading all major asset classes up 10%. Interesting, you have international stocks, particularly look at EFA, Equities here up 8.4%. So international equities outperforming the U.S. NASDAQ 100 continuing to rally here. You got value stocks outperforming growth stocks, which is pretty interesting as well. And then on the bond side, not big gains, but definitely seeing positive numbers across the board. And cash at the bottom of the list up about 0.5%. And cash is just going to be dependent on the Fed and what they do. If they hold rates steady, you're going to be getting, in terms of Treasury bills, somewhere between 4.25% and 4.5%. If they cut rates, you're obviously going to be earning less on cash. But interesting to see across the board gains so far in 2025 in terms of asset class performance. And this is the interesting thing here in terms of U.S. and international. We know U.S. stocks have been outperforming international stocks for over 16 years. That's the longest period of outperformance in history. Well, that's flipped so far this year. You see the World ex-U.S. ETF here up 7.2% total return. S&P 500 total return about 4%. So still very early, but this is the most interesting thing in terms of factors here, in terms of relative performance here, that the U.S. is actually underperforming because it's been outperforming for so long. That's the most interesting thing that we're seeing in the markets. The U.S. markets, though, still obviously doing pretty well. 4% gain in a month and a half is not terrible by any stretch. And if we're looking at the number of U.S. companies here above 1 trillion, we now have a record 9 of them, 9 companies in the U.S. with a market cap above $1 trillion. Just 7 years ago, there were 0. So just incredible here. And obviously, more and more of these companies, 10 years from now, there will likely be more. There's going to be growth in earnings, the economy, profits, but just stunning to see the past 7 years going from 0 to now 9 companies. And look at the list here. Obviously, many of these are household names, but Broadcom joining the list for the first time. So you got some new names here. Certainly Berkshire passed it last year, now back above it. And so just incredible. 9 U.S. companies above that $1 trillion market cap. Okay, why home price appreciation is slowing. Let's talk about the backdrop here. You're talking about, first of all, the affordability factor. Everything has to start there. And if we're looking at the mortgage payment that you would need on the median asking price home for sale in the U.S., you could see very, very elevated here, $2,753. A few years ago, 3 years ago, you could see way lower. And I'm measuring here since January 2020, just the crazy increase that we've seen. It's essentially doubled what you would need to afford. The median price home for sale has doubled since the start of 2020. And obviously, people's incomes have nowhere near doubled. And shelter CPI really isn't capturing this. It's up 27%. So definitely some of this, but there's a big bifurcation in terms of if you're looking to buy a home, that inflation rate in terms of mortgage rates are so much higher today and home prices are so much higher. That inflation rate for you looking to buy the home is much higher than someone who's already owning a home or someone who's just saying, I'm going to rent and forget buying a home. So big increase here in terms of what you would need to buy a home. And the big question is, well, what is that going to do to the housing market in terms of supply and demand? And thus far, what we've seen is a collapse in both, is a collapse in demand and a collapse in supply. And the supply has actually come down so much that prices over the past few years have still gone up despite the fact that the average home is unaffordable to the average person. And so a few interesting things going on recently, though, are number one, homes are actually selling less than their asking price, about 2% less. That's the biggest discount that they're selling for in a few years. So to me, this means that people's asking prices are too high and supply is starting to come back. So the buyer actually has a little bit of leverage here. I say a little bit because it's been a very slow move higher in terms of supply, but you can see here slowly creeping up. This is seasonally adjusted data, but this is actually the highest number of listings that we've seen in the U.S. since June 2020. So For the housing market to normalize, you need to really see this number continue to trend higher. I think all indications are that it will, as this lock-in effect that people have been talking about for a few years now begins to ease. And the lock-in effect is simply the idea that people who locked in low interest rate mortgages actually hit a low of 2.65% in the US a few years ago. Obviously, today they're about 7%, so a big increase. But what you're seeing is more and more people have mortgage rates above this 6% level. And the more that do, the more that have, as a percentage of the market, have higher interest rate mortgage. Well, they're not really tied to that rate going forward. So they're not as sensitive when they're looking to move, saying I'm going to be giving up that low interest rate mortgage. So as months go on, either people have paid off their mortgage, or you have the new entrants in the market from a few years ago now building up in terms of they have higher interest rate mortgages. It becomes a less and less of a factor. And you also have the situation that people are talking about, that people just simply have to move at a certain point. They have job situation change, family situation change, and they have to move. So this idea that the people are going to stay in these homes forever isn't obviously the case. It's just taking more time for the supply to come back in the market, and I think we're slowly obviously starting to see that. So year over year, we're seeing home prices up 3.8% over the past year, and it seems pretty likely to me, based on all of these factors, starting with the lack of affordability and ending with the fact that supply is coming back in the market. It seems very likely that this deceleration will continue here. So we had that huge home price spike here a few years ago. Prices moderated, but they never really did what they did after the 2007, 2008 financial crisis there. They never really went negative for a period of time to bring home prices and incomes back in relationship. So we're very stretched still as compared to history in terms of looking at where home prices are versus people's incomes, still trading at a huge multiple. So it shouldn't be surprising, I think, to anyone if we were to see flat growth for a number of years, or even negative growth at some point, if and when that supply comes back into the market. Okay, let's talk about DOGE here. This is the big story going on. Obviously, there's a new savings tracker that I want to talk about. But first, what is the backdrop in terms of why the demand for DOGE and the demand for cutting waste, fraud, and abuse is so high? Well, the backdrop is that we just have an unsustainable deficit in the U.S. here. We did 2.1 trillion. This was we got the latest data through January, 2.1 trillion over the past year. And this is really unusual in an economic expansion. So it's not like we're borrowing money because we're in a recession and people are out of jobs and we're trying to stimulate the economy. We're doing this in the midst of an economic expansion with the unemployment rate at 4%. So very unusual to be running a deficit of around 7% of GDP when you have that backdrop. And I just want to show you this chart here comparing the budget deficit as a percentage of GDP decade by decade, and you could see how unusual the 2020s have been. We've averaged so far this decade 8.8%. So simply unsustainable. And what we've done over the past decade is we've really ramped up spending way in excess of the income coming in. So you might think perhaps that this is a problem of revenue, we need higher taxes, but if you look at the actual data here, 4.9 trillion is now coming into the government in terms of tax revenue. That's 59% higher than it was a decade ago. So why are we in the situation we're in? Because of this red line here, the amount of government spending is now above 7 trillion, and that's 96% higher than where it was a decade ago. So this gap, this persistent gap between spending and revenue has caused a doubling in terms of the national debt from 18 trillion to 36 trillion over the last decade. And the only way to keep it from being 40 trillion is to try to close this gap, to try to reduce spending or increase tax revenue. No one's obviously talking about raising taxes, so that leaves the spending component here. And how much of this 7 trillion can be cut? That's the big question. And that's the question that we're starting to get an answer in terms of DOGE. They've been putting out, obviously, posts every day, pretty much what they're cutting. And Polymarket just put out a tracker of this, adding up all of the things that they said they have cut so far. And they said, and this is less than a month into DOGE's existence here, 26 days, and they total tally here is 49 billion according to Polymarket. So very interesting to see that they've cut this much this fast. Can they continue this pace? Obviously, they've talked about a goal of 2 trillion. I think if they got even to 1 trillion, that would be enormous. If we took 1 trillion out of the spending and we cut the deficit down to about 1 trillion, well, that would be about 3.5% of GDP, a much more sustainable number than where we are today at 7%. So we'll see. This is all very new. Obviously, new data and information coming out every day. As we get more information, I'll provide more data and analysis on this. But I think definitely encouraging if you're worried about the deficit, and I think most Americans should be. This is encouraging to see that we've already cut 49 billion in just 26 days. Okay. Want to end with something positive here, as we always do. This would be rising real wages. This is my favorite chart on the U.S. economy, on the health of the American worker. What you want to see is this chart in positive territory. And now we have 21 consecutive months where wages have outpaced inflation in the U.S. on a year-over-year basis. Before that, we had the longest period of negative real wage growth in history, and we've reversed a lot of that in the last 21 months. So very good news that wages over the past year have gone up around 4% and prices up 3%. So we want to keep that going. That's why we want to keep inflation in check. We don't want to see it continue to rise from here. Hopefully it'll start moving back down. But as long as wages are outpacing inflation, your purchasing power improves, prosperity improves, and this is great news for the American worker. That hopefully continues. All right, thanks everyone for joining me on the Weekend Charts. Have a great week. If you're watching this on YouTube, hit that subscribe button, and I'll see you next time on the Weekend Charts.